US Treasury yields keep rising, but is the market hiding election nerves? Welcome to Market Insight. I'm Elena Casas. The US economy keeps surprising to the upside, and Treasury yields hit a three-month high this Monday as investors price in a less dovish Fed. The elephant in the room, though, is the election, now 8 days away. The dollar has staged its biggest monthly gain in over 2.5 years as traders take their cue from the betting markets and position for a Trump presidency. Joining me now to talk about some of that is Garrett Melson, portfolio strategist with Natixis Investment Managers Solutions. Garrett, hello. How do you explain this move in the bond markets? Is part of it preparation for a possible Trump presidency?
Yes, well, I think it's always difficult to disentangle narratives when there's multiple forces at play. I think part of it is the fact that simply we've seen yields push too low leading up into the Fed's September meeting here. And so I think a lot of market participants were concerned about the outlook on the growth trajectory. And this is simply walking that back as we've seen some stronger data, a little bit of a firmer inflation print. But as you mentioned, certainly I think investors are starting to turn their eye to the potential outcomes of the election. And I think the broad consensus viewpoint is that either way things shake out, whether it's a Harris victory or a Trump victory, the markets are somewhat bracing for higher deficits and ultimately, I think, a greater supply backdrop. And that's helping to create something of a buyer strike, I think, within fixed income markets here within the U.S.
Trump, though, has promised tax cuts that would increase the fiscal deficit more steeply than a Harris presidency, it seems. What do you think the likely impact of that win would be on the bond market?
Yeah, absolutely. There are certainly differences in terms of the scale and size of that deficit, depending on who wins in the White House here. So certainly from that perspective, you'd expect, as what I think you've seen over the last couple of days here, markets maybe pricing in that Trump victory as almost a certainty at this point. And even to an extent, I think pricing in a little bit of that red sweep. And that's somewhat reflecting of the higher deficit as a result of some of those increases or I should say, reductions in revenues from tax cuts, and then the potential unknowns on the tariff front. That certainly is a complicating factor as well. So while I think markets expect deficits to be higher under both or either candidate, certainly skewed towards larger deficits under a Trump victory.
If bond issuance increases, then, would you expect investors to be more hesitant about buying them?
Yeah, this is always a debate within markets. And I think from time to time, especially over the last year or so, we've seen markets get very focused on the supply side for fixed income. Over my experience, and I think even further back than that, I think what you've seen is that supply tends to be maybe a short-term phenomenon, but at the end of the day, what you tend to see is that demand is certainly there. It might be a question of what the clearing yield is, but there is a lot of structural demand for U.S. paper where we live in a very financialized economy that needs that collateral, and U.S. Treasuries are the best form of collateral here. So yes, I think in the short term, at least from a narrative perspective, I think there's that concern about deficits pushing up and pressuring yields from a supply perspective, but I would fade some of those concerns. I think that it's not quite as much of a concern when you start to line up all of the sources of demand out there. Yes, clearing yields might be a little bit higher here, but I'd say we're already on our way to pricing in a lot of that, those concerns and those structural moves in terms of the supply dynamics.
How do you think these higher yields might affect the Fed's space to cut again, meeting as it does, of course, just a few days after the election result?
Sure. It's not too much, to be honest. I think the bigger picture still holds true, right? So when you think about what's going to be guiding the Fed's policy decision, you continue to see inflation on a durable trend back to 2%. Yes, it's still a little bit choppy. You've had a little bit of noise, but ultimately that trend is still pretty durable here. You have a lot of scope for continued softness and easing in the rent and shelter cost portion of the inflation baskets. And at the same time, you're seeing a lot of structural signs that inflation just isn't really embedded anymore. Unit labor costs basically not growing at all. So I think that kind of takes care of things from the inflation side of the mandate. On the labor side of the mandate, there's still a lot of questions. We'll have a lot of noise in the upcoming payrolls print this Friday. I don't think there's going to be a lot of clear read-throughs to where the trajectory is for the labor market. I think the Fed is a little bit more convinced that maybe things aren't quite as weak as we thought they were back in September, but the balance of risk still clearly leans towards the labor side of the mandate. And I think that does suggest the Fed should be cautious here and continue with that base case being 25 basis point cuts at this upcoming meeting next week and then the December meeting as well.
Do you think another unexpectedly strong jobs report this Friday would lead to more investor concerns that the economy is re-accelerating?
I do. I think most investors expect a pretty soft print just because of the effects of strikes, and certainly the latest hurricane striking during that payrolls survey week. So that is the expectation here. And if you do have a print that's not quite as weak as expected, or even a little bit stronger here, I think that helps to fuel that narrative of a no landing. We've kind of been oscillating between these narratives for quite some time. We certainly seem to see that pendulum shifting towards a no landing. So a strong payrolls print, I do think, at least from how the market trades this, the market's reaction function seems to suggest that stronger payrolls print leads to stronger growth, and it leads to a stronger inflationary impulse. So certainly we could see some incremental upside on yields if we do get a stronger print.
Well, thank you so much for that analysis, Garrett Melson of Natixis. And that's your market insight. Don't forget, you can watch more videos on Reuters.com.